Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Tuesday afternoon, we have Frederick, Managing Director of Trading Derivatives with Schwab, to discuss Nasdaq-100 performance, trends in the Nasdaq Volatility Index, and of course, we'll take a look at the macro picture with what's happening with geopolitics and of course, rising interest rates. Randy, it's great to see you as always. Welcome back to Trade Talks.
Great to be back, Jill.
All right, let's get a review of what you're seeing with the Nasdaq-100 with this macro backdrop, and of course, as we wind down earnings season here.
Well, today's been a pretty volatile day, as you know. Markets have been all over the place. Volatility has spiked and everything else. The Nasdaq-100 is down sharply. In fact, it's getting what I would call uncomfortably close to bear market territory, down about 17%. Now, here in the last half hour, 45 minutes or so, we've seen a little bit of a bounce back. And I think that came on the heels of President Biden's speech about Putin and Ukraine and Russia and all that's going on over there. I'm not sure what he said that calmed markets a little bit, but it's kind of fascinating because in the middle of the night, futures were pointing to a very deeply negative open. By market open, it was pretty calm. And then we actually went almost positive at midpoint. And then we headed back lower throughout the day, but things seem to be leveling off just a little bit right now. So yeah, about 3% of cushion here before we head down into a bear market. I hope we don't see that.
Right. And of course, markets like to remove any sort of element of uncertainty. So I guess with President Biden coming out and labeling what sanctions are going to be put on Russia, that kind of removes a little bit of the guessing game there.
It does. And uncertainty is what markets hate most. And, I always remind people that when we are in volatile times, you will oftentimes get big swings intraday and day to day. And that means big moves to the upside. We know for the most part, equity markets tend to move lower when volatility moves higher, but oftentimes you will get big sharp up days. And we're not actually having that today, but we do see these sometimes intraday swings and reversals. I would say yes, an element of uncertainty has been removed, but it may be only for the rest of today. By tomorrow, things could be the other direction again.
And of course, if we weren't talking about Russia, Ukraine, and a potential energy crisis, everything would be focused on the Fed and interest rates. Do you think an event such as this could potentially impact Fed policy?
Well, you're right. And it's fascinating. Now, we know, I think it's been virtually a certainty that on March 16th, we're going to get some sort of an interest rate hike. The odds on are that it's going to be a quarter point, but there are a few people out there who think it might be a half a point. What's fascinating to me is that as we came into today's open and things were a little bit shaky, there were quite a few analysts out there who said, perhaps this whole situation with Ukraine might actually lessen the probability of a 50 basis point hike. And yet, if you look at the futures markets that sort of forecast what the Fed might do, believe it or not, the probability of a 50 basis point hike has gone up today relative to where it was on Friday. Not a huge amount, but it's just about a 50-50 probability right now on whether we get a quarter point or a half. So yes, I do think it is having an impact, but fascinatingly enough, it's having an impact in the opposite direction of what most people thought it would.
Yeah, I guess if you figure, just rip the Band-Aid off on all fronts here, I mean, now's the time to do it. And to wrap up here, if you think about this from a longer term investor perspective, do you kind of ride this out? What does history suggest when we get into these sort of geopolitical tensions or heading into Fed rate hikes here?
Yeah, so history tells us that when geopolitical flare-ups occur, and there have been many of them over the years, it tends to cause a little bit of volatility in the market in the very short term. But in the long term, and in fact, I was on a meeting with my colleagues earlier today where we talked exactly about this. Whatever the trend of the market happens to be going into those events, after the short-term ripple and volatility is gone, and then sometimes that's a few days, sometimes it may be a week or two, the market tends to continue on into the same trend that it was already in. As you know, the market last peaked on January 1st of this year. The Nasdaq peaked in November of last year. It's down quite a bit from that point. It's been in a downtrend. I hope that doesn't happen, but ultimately, while this is causing a little bit of maybe extra downturn, when it's all over, things might level off, but then perhaps continue into the existing trend that it was in previously. That's kind of an odd thing, but that's what history kind of tells us. So far, the reaction in the markets to this event has been pretty much textbook and in line with what historical patterns have been.
All right, Randy, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.